Welcome to This Week in Money. I'm Jim Goddard. Today, CIBC Wood Gundy's Ross Clark will run down the action on the major markets. Author of the book, When the Bubble Burst, Surviving the Canadian Real Estate Crash, Hilliard MacBeth, talks about whether BC's foreign buyer tax had the desired effect, what could happen to Canadian real estate after Labor Day, and will you have time to prepare for a possible real estate crash? Danielle Park, editor of the blog Juggling Dynamite, comments on the financial situation facing millennials and how downsizing could help you face future hard times. Plus, at the end of our show, we'll have company showcase updates with American Manganese CEO Larry Gray and the co-founder of GlancePay.com, Penny Green. We'll talk to Ross Clark right after this.
Lotus Ventures Inc. is a BC-based medical marijuana company poised to launch into the rapidly evolving cannabis sector. Lotus is in the final review stage of the Health Canada approvals to become a licensed producer, having arranged facility financing of up to $12 million, plus building permits for its prototype indoor production facility. Shares trade under the symbol J on the Canadian Securities Exchange. Visit our website at lotusventures.ca.
Welcome to This Week in Money, the source for market opinions. Here is Jim Goddard.
My guest is Ross Clark. He's an investment advisor at CIBC Wood Gundy in Vancouver. Welcome back to the show, Ross.
Always enjoy being with you, Jim.
The Canadian loonie charging along, closing above 80 cents for the second time, I guess, in a few weeks.
It was about a month ago, I guess, that we were up to 80 and then gave back a couple of cents, probably gave back just a little over 25% of the run from the May low, and that's, there's some things that we have actions followed by reactions that are commonplace. In this case, a 25 to 35% retracement was going to be the norm, followed by then a retest of the high. So the dollar has come back now within, I guess, about a quarter of a point as of Friday's close of where it had been a few weeks earlier on the top of the run. So the norm now becomes a little more of a gray area. You'd expect that we would take out the high by maybe a cent, cent and a half, and then see what happens at that point. So the question will become, do we go through a reaccumulation phase here in this 78 to, say, 81 cent range to set up for a better rally, or was this the bulk of the move? And time will tell on that one. And I think, we have to take a look not just at the Canadian dollar, but you look at what's happening with the other currencies. The euro has gone through the same type of pause that the Canadian dollar has had, and it's back up to its high. The U.S. dollar index is at the lowest level as of the end of the week. We have to go all the way back to January of 2015 when the dollar was pretty much running on the upside to find levels that we have right now. So it was about probably 3 weeks ago, I think August the 2nd, that we got some capitulation signals. These are like downside climaxes for the dollar when we looked at the weekly chart on U.S. dollar index. And the norm there is that it then takes 3 to 5 weeks to try and establish a base. And so here we are. We've finished 3 weeks now. We've gone down to a marginally lower low. If it's going to create a base right now, it probably has to turn within the next week to 10 days. But on the upside, we take a look at the 20-week moving average, which is about 2.5 points above here. That should be the lid. Even if it were to turn right in here, that's probably the lid that you're looking at. And for now, I think it's too early to say that we'd be ready to go into the next waterfall mode on the downside. I think we need to, as I say, sit back with all of these currencies for the next week or 10 days and just see how they want to unfold.
The end of August, an important time for gold?
It has been. This is the strong seasonal window that we're in the midst of right now. So you expect to see it move well from late July through until the end of September. There's a few key points along the way. The end of July with the first week or so of August are critical. If you can break out, then the probability is then that you will be strong through August. Yeah. And as you reach the end of August, you get to that next point. Probably in the last dozen years, the end of August has been one of the most crucial turning points in the gold market. So as we get into the middle of next week, I think it'll be important that you have tight stops as far as the gold market is concerned. If you're a trader, if you're a long-term investor, you're probably just looking at the 1272 as a significant support level, because we've got this big saucer pattern that's been taking the better part of a year and a half to 2 years to form, and resistance still being in that 1310 to maybe 1360 range above us at this point. But it's really going to have to start to gain some momentum as we move into the early part of September, or I think we can be due for a pretty decent correction.
The Canadian dollar did go up even though oil stayed the same. Is that something new?
This has been something that's surprised most of us. The correlation between oil and the Canadian dollar and the grain markets, historically, the CRB, it's been very, very tight. And this summer, pretty much all summer long, Canadians been quite independent of the oil market.
Ross, thank you so much for talking with us.
As always, Jim, nice to be there.
My guest has been Ross Clark. He's an investment advisor at CIBC Wood Gundy in Vancouver. Coming up, Hilliard MacBeth, next on This Week in Money.
Always consult your investment professional before making any investment decision.
I'm Douglas Mason, President and CEO of Rainy Mountain Royalty Corp., RMO on the TSX Venture Exchange. Rainy Mountain's Brunswick property is located in the Rideout Shear Zone in Ontario. With grab samples running as high as 32 grams per ton gold, a drill program will commence this spring to test the numerous targets located by recent groundwork. For more information, visit our website, rmroyalty.com.
Aven Resources Limited is a gold exploration company with significant projects in British Columbia, Saskatchewan, and the Yukon. Trading on the TSX Venture Exchange, symbol ABN, and the pink symbol ABN-AF. Surrounded by world-class gold deposits and mines, Aven's 23,000 hectares Forest Kerr Gold Project is located in the heart of the Golden Triangle in northwestern BC. For more information, visit us at avenresources.com.
This Week in Money is archived online at talkdigitalnetwork.com.
Welcome back to This Week in Money. I'm chatting with Hilliard MacBeth, author of the book When the Bubble Burst, Surviving the Canadian Real Estate Crash. He's also a portfolio manager and financial advisor in Edmonton. Welcome back to the show, Hilliard.
Nice to be on the show.
The BC government reports it made $102 million from its foreign buyer tax between the time it was imposed last August and when they finished wrapping up their books in December. Does that show the tax was working, or that for the very rich, the tax doesn't matter?
It sounds to me like that's not very much money, considering the billions of dollars every year that flows through just Vancouver alone. And so it seems like they might be missing some of the revenue that potentially could. But it's a fairly new tax, so maybe they need to beef up their surveillance and their investigation. Numbered companies are always the problem, and a lot of the foreign buyers are based in numbered companies. And how do you determine if that's a foreign numbered company or a local domestic numbered company? It depends on who the beneficial owners of that corporation are, and sometimes it's very difficult to find that out. The anti-money laundering rules under FINTRAC require that realtors, financial advisors, banks, notary publics, everybody is required to find out all of the beneficial owners of those numbered companies. But do they actually succeed in doing that? I don't know. And of course, the big loophole that everybody drives the Mack truck through is that lawyers are exempt from that requirement. So there's probably lots of foreign buyers that are not, they're finding ways around the tax, but there would be no way to really know for sure.
And what if a corporation bought that home instead of an individual?
Well, in the Canadian corporations, so there's the small business tax, which is quite a bit lower than the regular tax that the rest of us pay, was designed to encourage small business, people with, maybe 10, 20, 30 employees to grow and expand and thrive. But what happened was they also allowed professionals like doctors and lawyers to open up professional corps, and they also get the small business tax. And of course, they're not supposed to get it permanently. They're supposed to just get it temporarily, and then when they take the money out of the corporation, they pay a second tax, which brings it back up to the regular tax. But people being people and accountants and people being very creative and innovative, they found ways to invest through these corporations and avoid some of the heavier taxes that they normally would pay. And so Finance Minister Bill Morneau has just announced a huge change in that area, which will make it much more difficult, if not impossible, for people to do that. But in the meantime, there probably are quite a few people that are investing through the corporations and avoiding some of the tax that they normally would pay. If it was not a principal residence tax, of course, the principal residence you're exempt anyway, but everything beyond that, speculations and investment properties, I'm sure there are some people that are finding a way around the tax by using corporations.
Well, of course, if something was invented by a human, another human most likely can defeat it.
Exactly. And now the finance minister is pretty aggressive, and there's a lot of upset people. We're basically getting calls almost every day. And most of the people that are calling us are not really affected that much. But some people were using very aggressive techniques like having members of the family to be shareholders of the corporation and sending out dividends to each member of the family, even some members that are only 5 years old. And that really wasn't that's called sprinkling, by the way. That really wasn't the original intention of allowing that small business exemption. And Morneau seems to be pretty serious about tightening it up, as they are serious about cracking down on people using the principal residence exemption in real estate, people that don't actually qualify for the principal residence exemption. So it's a different world. Starting in about a year ago, we woke up and both the BC government and the Ontario government and the federal government, they've all changed their attitude from very loosey-goosey to a much more regulated and regimented environment. And I think it's going to put quite a damper. I think it perhaps already has put quite a damper on real estate in Canada.
Well, I understand the Conservative Party plans to fight this crackdown. They say it's an attack on families and farmers. Yeah,
farmers. Well, I know you're from Alberta, and I'm living in Alberta. I know that farmers, although a lot of them would never admit this, but they are treated pretty well by the political system. And of course, they take a lot of risk because they have to have a real active faith to plant in the spring, and then hope for rain and hope for sun and avoid the hail and everything, and then hopefully have a profit in the fall. And but they do get a lot of tax breaks. So I don't know exactly how it works now. The other thing that's happened in farming is that it used to be individual families farming, and then most people would probably support the family getting a tax break. But when you get into corporate farming, where people buy up sections and sections and sections of land, and it's a huge corporation with investors and stuff, should they really be getting the exemption that other farmers get? Probably not. But I think this whole thing is a new era. We're heading into a new era.
The federal government says it's not really boosting taxes, but they just want to make sure people who owe tax pay it. And they are aggressively trying to close loopholes. The people, of course, taking advantage of them say, well, right now it's legal. Why are you going after us? We're not criminals.
Yeah, and they're not really criminals. I think people were taking advantage of the loopholes. Obviously some people were overly aggressive, but a lot of people were just following the recommendations of their accountants and taking advantage of loopholes that existed. So the government has determined that maybe that's not fair, in the sense of people that work for wages and salaries don't have the option to create a corporation and get these extra breaks. So I think, like a lot of things, it started out as a good idea to encourage small business, and then it got it kind of morphed into something where people were just using it for avoiding taxes rather than to create a boost in employment in small business. And so the government's probably doing the right thing to tighten things up again.
Are people in China still getting money out of the country by organizing in China? 50 grand supposed to be the annual limit, forming corporations there to get money into places like Canada and the U.S. to continue to buy real estate?
You know, it's hard to tell. You hear a lot of stories almost daily that China is cracking down on the exit of money outside of China into Vancouver, and the hot new era is Vancouver's been replaced by Seattle. I think you may realize that number one's always been Los Angeles, number two has been San Francisco for a long time. Vancouver used to be number three, and now Seattle's taken over about a year ago. So one of the reasons that Vancouver did so well was because Canada had really loose and lax rules in terms of tracking these things. And now that the Canadian government and the Chinese government have started to cooperate with each other to identify people that are taking advantage of this, I think it's a completely different ballgame. But I've been following this for quite a few years, probably 30 years, and it seems to me that every time China announces a crackdown on these things, a very short time later, like 6 months, not even a year later, we hear that people have found a new way around the rules. So, again, where we started out a few minutes ago, the innovative mind of the human being has virtually no limits.
And Canada, too, although BC in the lower mainland and Ontario now have foreign buyer taxes, they are using apparently relatives or friends already in the country to make the purchases so they don't have to pay the tax. Is there any way to crack down on that?
I don't think there is, unless, if people actually live here, then that's a valid resident. I don't think, the non-resident tax doesn't say you have to be a citizen, or you just have to be resident. And the definition of resident is fairly loose. I think Ontario's struggling with the definition, but obviously a student qualifies. And, as somebody said, it all comes down to who you trust. So if you have an uncle or an aunt or a cousin or even just a friend that's living in Canada, and if you trust them enough, or if you have enough power over them that you can exert pressure on them if they try to abscond with the money, you can put the money in their name, have them buy the property for you, and then have an understanding that when you actually make your way to Canada, you want that property put into your name. And so certainly relatives, but even business associates, probably depending on the relationship, could be used if they were based in Canada to register a property in a resident's name. So maybe that foreign buyer's tax will never collect that much money because there's all these ways to get around the rules.
Can you gift a person that house?
Well, if you gift it to them, then how do you get it back, right? So it's like there's always, what if you have a falling? Well, it could be your best buddy, but what if you have a falling out a year from now? So it's a dangerous thing. If you're talking about a house in West Van that's selling for $3 million, you'd want to have some kind of a hold over that person. Obviously, a son or a daughter or somebody like that. But who knows? Maybe maybe the people have ways of doing this. I know in Thailand they have a rule that foreigners cannot own and control real estate. It has to be a local person. So the way they get around it in Thailand is, now this goes back a few years, so they may have changed it, but at that time, you would set up a corporation and you'd give voting shares to the local people, but the foreigner would have the non-voting shares and own all of the assets in his name. And it worked great. So 51% of the voting shares would be owned by the local people, who often would be people that were just nominated by the local lawyer in Thailand. And of course the problem is, so that worked great, and then it qualified for domestic ownership. The problem is, what if the lawyer decides to get all his friends together and vote you off the island to get rid of you? I'm sure that happened. So, But when I was in Thailand, I don't know, 15 years ago, I guess it was, the people there from Hong Kong and from England told me that's what they were doing. And I thought, wow, you got to be a trusting kind of person to do that. But people will do stuff. I don't know. It's surprising.
We'll have more with Hilliard MacBeth next on This Week in Money.
I'm Larry Ray, President and CEO of American Manganese Inc., listed on the TSX Venture, ticker symbol AMY, A-M-Y, with proprietary patents in the U.S., China, and South Africa. Our focus is on recycling lithium-ion batteries for electric vehicles. China recently legislated the responsibility for recycling onto their electric vehicle manufacturers and importers. For more information, please visit AmericanManganeseInc.com or phone me, Larry Ray, at 778-574-4444.
Arctic Star Exploration, operated by a team of proven mine finders, is focused on diamonds in Finland and the Northwest Territories of Canada. A work program is planned for our Finland property that contains diamond-bearing kimberlite. Arctic Star trades on the TSX Venture Exchange, symbol ADD, and the Frankfurt Exchange, symbol 82A1. Please visit our website at arcticstar.ca or call us at 604-689-1799.
This Week in Money is archived online at talkdigitalnetwork.com.
Welcome back to This Week in Money. I'm Jim Goddard. We're chatting with Hilliard MacBeth, author of the book When the Bubble Burst, Surviving the Canadian Real Estate Crash. Hilliard, what do you expect to happen to the Canadian real estate market after Labor Day?
Well, I've been tracking pretty closely Toronto, because Toronto, I suspect, will be the epicenter of the earthquake if the earthquake ever hits in the real estate market. And you probably have heard that a couple of neighborhoods like Vaughan and Markham, which are kind of suburbs of Toronto with very large McMansions, as they're called in the United States, a lot of them bought by foreign buyers, have been suffering some pretty big price drops. The price drops as big as 20% since April. And the listings I've been tracking have actually new listings have continued to appear. But most of the people in Toronto now are saying, well, we'll see in the fall if there's a pickup in buying coming back. So it's only, 2 or 3 weeks away. The local realtors claim that there is usually a pickup in buying. I don't know about that, but certainly December is the slow period, the start of the slow period. So basically we're looking at September, October, maybe part of November to see what's going to happen. But the reality is the impact of the tightening of the finance and companies getting into trouble like Home Capital and possibly other lenders like that, non-bank alternative lenders, the shadow banks, as they call them, it's got to have an impact on what people can do. There's just not that many people that qualify for homes that cost $1.8 million or $1.5 million or $1.3 million. And that's the segment I've been watching. And it's very weak. Like if you really want to have a $1.5 million home in Toronto, there's a lot of, just in August alone, over $950,000 in the greater Toronto area. There's something like 2,200 new listings just in the last 23 days. So there's obviously a lot of supply, and if the buyers don't show up in September, there's going to be a pretty big bloodbath in Toronto.
I've also heard West Vancouver has a huge supply of homes on the market. They said 3 years worth of inventory if they sold at a typical rate. Do people wait 3 years to sell their house or wait that long for it to work?
Well, that's what we're going to find out. So how desperate are those people? So that the situation is, if the lender is involved and people, like I suspect, I don't know about West Van, but in Toronto, in some of these neighborhoods, I'm sure because prices were rising so rapidly in 2016 and early part of 2017, a lot of people ended up owning two homes, the one that they lived in and then the one that they wanted to move to, the more expensive one. They bought the more expensive one before they sold their current home. And then when they finally got around to selling, maybe they were greedy and they said, well, let's hang on to both of them for a while and then we'll sell later after the prices, because the right prices were going up 20% a year. And then they got caught because they were almost like within a week, the market completely changed in April. And So those people will be desperate, and some of those people are probably already forced to sell, and who knows? Like, they might have to take for survival. They might have to take a big cut. And I think the buyers are aware of this. So the stories that are circulating right now in Toronto are that the buyers are looking for bargains, making offers $400,000 below asking for a $1.2 million house. And the sellers are on the edge of panic, but maybe haven't quite panicked yet. And some of them don't have to panic. The thing, that's why I'm watching the new listings, because it seems to me, if somebody was in mortgage free or didn't have any financial pressure, why would they list their home into a market like this? They would just pull back and say, oh, you know what, we'll wait a year and see what happens, or we'll wait 2 years or whatever. So the people that are listing in the last 23 days, 2,200 of them in the higher price range, they probably are pretty motivated sellers, as they call them. And so that'll be an interesting thing to watch if they're forced to take a big pay. And then we haven't even talked about condos or new homes. So there's the new home construction. Of course, the last few months we've been hitting record high levels. A lot of it's multifamily, but a lot of it's single family as well. And the builders, invariably, the builders are under immense financial pressure, because a lot of them borrow their equity for when they go out to build some homes, and they can pay interest rates as high as 10, 15, even 20%, because they're able to repay the loan as soon as they make some sales of houses. So if they don't make any sales now, they're really on the hook for those homes. So the new homes and the people that are stuck with two homes, that'll tell the story come in September.
The greater Vancouver area has some 39,000 constructions on housing right now. Somebody said that's either way too many, or, considering the fact that up to 43,000 people a year move to the Lower Mainland, just right.
Yeah, I've done the numbers for Alberta and Toronto, and I haven't done the numbers lately for Vancouver as to how many people move there. But and you have to put quotation marks around the word move, because some of those people are sending, like, they've got if they're coming from China, for example, they might be sending a son or a daughter to university. So that's moving to, I don't know. It used to be not that long ago that students would just rent a student housing or something. They wouldn't buy something. So, but a lot of these stories are inflated. I remember hearing in Alberta that 70,000 people a year were moving to Edmonton. Well, the actual numbers over the last 10 years they were high. They were 2.1%, but on a million person city, that's 21,000 people a year. So they never got up to the numbers of 60, 70,000 that everybody was repeating to each other. And those numbers have been declining. So Toronto, even less than 1%. So a lot of these stories, I think, get told, get repeated, get exaggerated. I would be very cautious about accepting those numbers at face value. I think it's mostly speculators, and whether they move here or they just speculate. And as we know with speculators, if the market levels off, they lose interest really fast.
And what about the condo market? What's happening there?
Well, the condo, the multifamily and the total housing starts for the last several months have been hitting new record highs. And I don't know in Vancouver, I haven't checked lately, but Edmonton, Calgary, Toronto, they are just building so many units, and there's a huge completed but unsold supply of condos on the market, and yet they're still building more. So, and Vancouver had one of the, as you mentioned, they've got over 30,000 under construction. So these are huge numbers. Like, if an average building has 200 units in it, that's 15 buildings under construction. So I guess the developers of those, one of the things I've learned in the last couple of years is that builders don't really have a forecast for future growth in the demand for whether it's condos or houses or whatever. They tend to just keep building until one day they wake up and realize, hey, I got all these condos I can't sell. And because there's been really for at least 10 or 15 years now, there's been really no reason to hold back. The people who made the most money were the people that built the most condos, and they always could sell out. So there'll be a lot of surprised people if one of these buildings doesn't sell out, and there's a lot of them, and based on those numbers, there's 10 or 15 buildings that need to sell out in the next year or two, and that's that would be a scary proposition if you'd put up millions and millions and millions of dollars of your own money, thinking that you were going to sell it out, and then found out that you couldn't.
Well, in Greater Vancouver, you're hard-pressed to look in any direction and not see several construction cranes. So the building boom definitely is still going on.
The building boom will continue long after the demand, for whatever reason, slows down, because they have to decide 2 or 3 years in advance to start building that building. It takes a couple of years at least to complete it. So if you're deciding based on 2016 numbers and it isn't completed to 2018, and a recession hits or the Chinese finally do crack down on the money leaving China, you could be stuck with a lot of units that are impossible to move.
And of course, too, with condos, people who couldn't afford a townhouse or a single-family home, but still want to own real estate, where else are they going to go to a condo, which of course will be cheaper than a house?
Yeah, that's what Vancouver realtors tell me recently, is that the more expensive westbound homes are dead. There's a lot of them for sale, and they're not moving. But condos are really hot because people have moved down into the more affordable range. So that dream of, if I buy a property, I can't fail but make it money, is still alive. And it'll take a pretty big correction to beat that belief out of people, if it ever does get beaten out of them. But I suspect it will at some point. But it'll be only after the correction has been with us for quite a while before people finally wake up and say, hey, buying a condo for $800,000 for 700 square feet just isn't really a good idea.
Well, you are the author of the book, When the Bubble Burst, Surviving the Canadian Real Estate Crash. Are we looking at a crash?
Well, in Alberta, we've been living with not a crash, but a really weak market for since the recession hit in 2014. And in Toronto, it looks like it started in April of 2017, and in Vancouver, it seemed to start in the summer of 2016, and then we had a recovery, at least in the condo segment. So I think we are at some stage of the beginnings of a crash, but I just don't know. We won't know till after, when did it start, how long does it last. But if it's like the one in the U.S., it'll last at least 5 or 6 years, if not longer, and it'll go through many, many stages. So there's still lots of time for people who are thinking about maybe cashing in some of the profits they have, or maybe reducing their debt. There's still lots of time for people to make some changes that will simplify their lives and reduce their risk. And I would strongly recommend, especially people that are heavily indebted, that they do so now, and don't wait for when the signs are clear that, we are in the crash already. Then it's too late. You kind of have to move before the signs are before the neon lights are flashing, and you got to make your move early.
Does that mean you should wait right now to see if prices do drop?
I would, if somebody's got a problem in terms of owning too much real estate or having too much debt, or just wants to cash in their profits, I would move now. I wouldn't wait for somebody to sound the bell, because nobody ever does ring the bell. In Toronto, I heard from a couple that had a neighbor, and they heard them in a screaming match. The one spouse accusing the other spouse of not agreeing to sell in February when they wanted to sell, and now they're stuck. And I don't think people have screaming matches just because they missed out on a profit. I think it's because they're stuck with huge debt that they can't handle. And that's the scary thing about all this. It's all fun and games when prices are rising, but when prices fall, the debt stays. The debt doesn't fall with the house prices, and that's where the problems really start.
Also, I've heard in Toronto, some people are walking away from their deposits because now with all the mortgage stress rules, they're realizing there's no way they could support that house if interest rates go up another 2 or 3 times.
Yeah, we're doing some work on that, and the interest rates have risen quite a bit. The 5-year Government of Canada bond rate has gone from 0.5%, a ridiculously low amount, to 1.5%. So basically it's tripled. The mortgage rates haven't really responded yet, but what's happening is the availability of mortgage rates below 3% has shrunk dramatically because of all these changes that came in the mortgage finance through CMHC and other changes that were done by the government in November and December of last year. So if people can't qualify for that limited amount of say 3% mortgage money, they're forced out into the higher numbers, and it's quite difficult. I mean, the amount of debt that's now outstanding is triple what it was 15 years ago. So even a 1 or 2% increase in the interest rate is going to be a huge burden for households generally in Canada, and some of the households just can't handle it. Right? We'll find out which ones can and cannot handle it, but I'm sure there's quite a few of them that can't handle it.
Hilliard, how can people find out more about the MacBeth Group?
So they can go on to themacbethgroup.com, and it's a free sign up to receive the weekly note that I write, or occasionally have guest authors that write. And on that also there's lots of links to interviews and different information that we have about our services. So and also people can my email address is on there, and people can send me an email if they want. And I've heard from dozens and dozens of people from all across Canada, and it's actually quite interesting to learn more and more about people's situations, and I'd be happy to hear from them.
Hilliard, thanks for being on This Week in Money.
Thanks very much.
My guest has been Hilliard MacBeth, author of the book When the Bubble Burst, Surviving the Canadian Real Estate Crash. He's also a portfolio manager and financial advisor in Edmonton. His website, MacBethGroup.com. Coming up, Danielle Park, next on This Week in Money.
I'm Brian Fowler, president of Blind Creek Resources Limited, listed on the TSX Venture Exchange, ticker symbol BCK. Blind Creek is focused in the Yukon, Northwest Territories, and British Columbia. The company's key property is the Blend Project, one of the largest undeveloped lead-zinc-silver deposits in Western Canada, plus plans to advance the recently acquired, fully permitted historic engineer gold mine in the Atlan District of Northwestern BC. Check us out at blindcreekresources.com.
I'm Bill McWilliam, president of Cascadero Copper, CCD on the TSX Venture Exchange. Cesium is one of the world's rarest metals with a growing industrial demand. Drilling is underway on our Tehran property in Argentina to prove up a cesium resource. Cascadero's patent-pending leach process has the potential to make Cascadero the lowest cost supplier of cesium in the world. Visit our website, cascadero.com, or phone us at 604-924-5504.
Glance Technologies owns and operates Glance Pay, a disruptive mobile payment technology now live in 16 cities in Canada and about to launch in the U.S. With revenues up 664% in the last quarter, Glance Technologies has the potential to be a worldwide leader in an industry projected to grow to $1.3 trillion in 3 years. Glance Technologies stock symbols are GLNFF in the U.S. and GET in Canada. Find out more at glancepay.com.
This Week in Money is archived online at talkdigitalnetwork.com.
Welcome back to This Week in Money. I'm Jim Goddard. We're chatting with Danielle Park. She's the editor of the popular blog Juggling Dynamite and president of Venable Park Investment Council Incorporated. Welcome back to This Week in Money, Danielle.
Hello, Jim.
What is the financial picture like for millennials who now outnumber baby boomers in Canada?
Actually, that statistic that I was speaking about on the blog this week was actually a U.S. statistic, but the millennials are the largest population group coming after Canadians as well. So their boomer parents, were this big cohort that drove a lot of economic and financial trends in the world since they were born, and they're all now in the 53 to 70 years age group. And the group coming behind them, the millennials born between 1982 and 1997, are now in the 20 to 35 range. So these are, in terms of, the actual numbers, they are about 75.4 million in the U.S. versus the 74.9 million boomers that were born between 46 and 1964. So in terms of actual size, they're the same, but of course in terms of the percentage of the population when they came to be, boomers, it was a much smaller American population and global population when boomers were born. So relatively, boomers were still a net larger impact. But the point is that millennials have come into their consciousness about the world at a time in the midst of the great credit crisis, in the midst of the financial crisis of 2008. They watched their parents, lose savings in financial meltdowns. They watched mass unemployment. They've suffered since with poor job prospects, weak wages, weak job markets, not a lot of great opportunities, and they're saddled with student debt. They are the most indebted generation coming into their working years of any generation before them. So all of this has really set them up with a healthy skepticism about financial services, bankers, the whole way in which information is given as advice or sales pitches are made through the banking system on products. That whole thing has given them a very sort of jaundiced look. And that is actually something that I liken to what my grandparents, who were the silent generation, born at the turn of the century. And I remember growing up in the 60s and 70s because they happened to help raise me that, they were very negative on bankers. My grandfather used to curse about, the damn bankers. And so I'm reading many things lately about millennials, and they are having a similar sort of distrust of banks. And I think that that is probably a healthy thing and likely to last for their entire generation. And I say that knowing that we are very likely close to the next global recession, the ongoing credit crisis, which still plagues the world because we have more debt now on every level than we did in 2007, and also when we get into the next financial bear market, which, is part and parcel with recession and credit crisis, you're going to see that the gaps in pensions and social funding are going to be that much wider. And I think it's just going to reinforce again for the millennials who've seen a great deal of this crisis in their short time frame already, that there's much wrong in the world in terms of the way banks are allowed to be these massive investment conglomerates and cross-selling across the board, in the way in which people have been able to act within corporations and commit all sorts of financial fraud and get out of it just by paying fines and moving on. I think that the political pressure that we got in the 1930s as a result of the financial, crash of 29 and the depression that followed, that revulsion in the public, my grandparents' era, was the political pressure that was needed to finally bring about some large regulation changes, like breaking up the banks in Glass-Steagall, like actually holding actors accountable for criminal acts and prosecuting the directing minds behind the institutions. Those things were the pivotal moments that finally set the world up for a better period of time thereafter, and I think we're going to get that again. As I say, once this next recession and bear market comes for financial markets, I think the revulsion in the population and primarily in this group that's already quite negative on the banking sector, the millennials, will help because they are going to be the dominant force in the voting, in the political system, and, they're going to require things like, a ban on stock buybacks and other financial sort of gimmicks which have been so dominant in the last couple of decades. It used to be that stock buybacks were considered illegal market manipulation, and up until 1982 they were not allowed to be done. Corporations were not allowed to do that, borrow money and buy shares the way they've done in the last decade with such a vengeance. And that has really driven asset prices to very high levels and high valuations, is really pumped them up, but at the expense of the balance sheet, because all the debt is still there, and when the asset prices come back down, the debt will still be, will be even more large in relative to the equity. So all those things are just sort of basic. We need to break up the banks. We need to put back some of those rules, and I think that all of this generation is going to help this younger generation.
Of course, millennials now face rising interest rates, something that baby boomers didn't face. They saw interest rates fall.
Well, if you remember, though, early on in their lives, the baby boomers certainly saw interest rates rise with their borrowing demand, into the 1980s. And, of course, there was that really anomalous peak in rates when you look at a long-term chart, it really was an anomaly because long-term rates have typically always been, in the 3 to 5% mortgage rate range, and what you saw was a huge jump into 17 and 18%. But a lot of that was based on the inflation that came from the spending in the U.S. for the Vietnam War and a lot of the commodities pressure that built up. And the OPEC oil embargo, all that sort of thing. So we have a very different dynamic in the world today because we have, people heavily indebted. We're into a new era of resource utilization in a higher efficiency. So people are, because of technology, because of sort of awareness about the constraints in the natural world, I think people are just naturally migrating to an interest in more efficiency and less, waste and that sort of thing. And so cost is part of that because they have lower wages and higher debts and little ability to take on extraneous payments from here. So all that is really depressing the likelihood of interest rates rising very much over the next few years. I know that the Bank of Canada has been making noises about raising rates. We've seen some sell-off in the Canadian Treasury market in government bonds in the past few months because of these noises that the Bank of Canada has been making. But they've been really doing that to try and put some sort of fear into the runaway debt market in Canada, the borrowing binge that we've been on as Canadians, the excessive household debt levels, which are a great risk now to the Canadian economy. And so the Bank of Canada has been really trying to weigh against those debt bubbles and the runaway housing market, which has made housing unaffordable for most Canadians and certainly for most millennials. All that has been something they've been trying to sort of weigh against, but at the same time, we have this very troubled economy that, although has been, growing in recent months and years on the housing bubble and the construction that's gone into that and the related services. In reality, now we're at this inflection point where you're seeing a fall off in the really hot markets where, by the way, people have been spending over 70% of their income just to keep the roof over their head. Not sustainable. Places like Vancouver and Toronto, that's just crazy because people don't have enough money to live just to keep the roof there, but no savings, no ability to sort of get ahead in any other financial goal. So all that is sort of very negative for the Canadian economy at the same time that we have the oil price, again, slumping. All the forecasts when we looked into this year and into the next have been the economic forecast for the country on a federal level, and many of the companies have assumed this bounce back in oil prices, north of $60 a barrel. And in fact, we're back, well below 50 here. And the real world shock, I think, that people have been underestimating here is that although OPEC has cut back on production, they had the OPEC agreement this year, and that's in place until March of 2018 as a way to try and buoy prices. What people have not maybe appreciated is that, in fact, China has been the offset in this time when OPEC's been producing less, and we have generally softer demand in the world. You have China that's been filling its strategic reserves with, everything it could kind of grab year to date. And the reality is that they've recently cut back significantly because their reserves are nearly full at this point. So at some point in 2018, it may be in fact early, you could see a dramatic decline in the amount of oil that China's been buying on the world market. And if that's the case, then there is no other offsetting purchaser here to sop up the excess demand that still exists in the world at the same time that you have OPEC and company hoping to start pumping more again in the first quarter of 2018. So I think it's much more likely that we could see a lot of weakness in the oil price over the next 6 months rather than this bounce back that everybody's been banking on, in which case you're going to see continued stress in the oil patch, continued disappointment in terms of that's heavily indebted in that sector and strain through all the knockoff effects that has, including into the banking system, at a time when there's not another obvious marginal buyer, to sop up supply, and Canada really doesn't have a lot of strength now with its over-indebted economy. So all that is really setting us, I think, up for a disappointing phase. heading into 2018. And it's going to be difficult for all sectors of the population, young and old, in that environment, especially, the young people, because they'll face higher unemployment again, not so much higher interest rates, I think, but just carrying the weight of the debt that people have, even if rates don't go higher here, is going to be a continual challenge. And it's going to last for the next few years. It's not like we can just sort of quickly get this debt bulge out of the way. Some of it will be written off. Some of it will be reorganized, bankruptcy, trustees, insolvency, all that sort of thing. But a good deal of it's going to hang over and, hold back the consumption ability in the economy for the next couple of years, I think.
Do we concentrate too much on consumption to power our economy?
Oh, absolutely. And this has been, again, we're at the end of the largest credit binge bulge bubble in human history to date. And we've really hit the end of the line of credit. We thought we'd done that in 2009, and the lessons were being learned about, you have to rebuild savings rates in the economy. The real strength for the future comes with financial resiliency built on lower debt and higher savings. Savings becomes the investment capital available in the economy, and it's those kind of, intelligent decisions about where to place savings that have always driven productivity and innovation and efficiency leaps in the economy. And that's where the future gets its strength from. And what we've done for the last, 20 years in particular is the opposite of that. It's all been about mindless, consumption that adds nothing to long-term strength or efficiency. All consumer good consumption, hoarding of depreciating assets in one's garage, basement, cupboards, wherever, things that don't really add value or quality of life over time and actually become a liability in terms of things you have to store, maintain, insure, so very expensive. And so the whole thing was built on this add more debt and stir, force people to consume more, and people are now, they woke up in 2008 in the financial crisis and said, oh no, I've got all this junk that I can barely sell for anything, and I don't have enough savings or things of value. I've got financial assets which have just crashed by half. I really don't have enough liquidity. So all this revelation really hit in that last downturn. But because they, brought in the QE liquidity that began in 2009, this money printing at the Federal Reserve, that was directed into the banking system, it was this extension on the line of credit again. And really that's the money we've seen flow through financial assets and reinflate housing prices and create all this inefficiency all over the world now. Some people have got incredible excesses, and others, the masses, have hardly enough to get by. 78% of Americans in a survey this week report that they live paycheck to paycheck. That's workers, not just people on social benefits. We're talking about workers. Nearly 80% of them say they have no savings, and they're basically, going paycheck to paycheck. So there is very little stored strength in that kind of an environment. Canada's in the same boat. And so once we get this next slowdown period, I think that it's going to sober people up, and they will remember, yes, I learned this in the last downturn, that financial assets can drop by half, that I actually need to have less debt and more savings, and I need to have more income than I'm spending, and all these sort of basic equilibriums come back into awareness. And I think that because we can't just do, they may try and do some more QE, but they're already at the end of that narrative in terms of belief and, tolerance politically. As I said at the start of the call, I think people are less inclined to support these kind of crazy policies because they see the negative and the cost that flows through the economy and through society as a result of them. And so I think we're at an inflection point where the new model is all about having more for less, spending less, lower utilities, less waste, getting cut out middlemen. We're seeing that in all sorts of businesses, whether it be, in energy and production of, on-site and lowering your cost through all sorts of efficiency, or whether it be through fintech where you're, trying to cut out a lot of the banking services and go for a more direct model where people are doing peer-to-peer transactions more. I think that there's just this natural inclination of an over-indebted population at this point to say there's got to be a smarter way to do this that will bring us more peace of mind and more personal resilience instead of always relying on, the debt drug.
Moving on to the future, which is the present, robot cars are actually here right now. Someone said they're years away. They may never happen. Google staff, for example, in San Francisco are transported by autonomous cars.
Yes, and there was an article this week as well about companies in the oil sands who are starting to use autonomous trucks. They are doing it right now because, again, with this pressure of the oil price not getting back over $50 and weakening again in this month, they're having to figure out ways to lower the production cost, and so autonomous cars are autonomous trucks are one of these ways. And yes, by all estimates, I think it's very interesting because as with all major transitions, there's the this'll never happen phase where everyone is in denial or, just loves to hate the new idea and proclaims it as preposterous and ridiculous and it'll never happen. And then you get into the phase where people say, well, sure, it'll happen, but it's so expensive, it'll never be mainstream, And then by the time the masses sort of say, okay, well, sure, it's happening and, it's already a way done deal. So I think it's interesting when you have some of the more, the status quo businesses, like, for example, OPEC, obviously in the oil production business, but they too just raised their prediction for electric cars, for example, to 12% of the market within 23 years, which is still extremely conservative, I think. But that compares with an estimate they had of just 2% of the market being electric in their 2015 forecast. And similarly, BP just updated their forecast. They thought that they would see 100 million EVs on the road by 2035 as their most recent forecast, and that's up 40% from just a year ago. So when you understand that again, these phases that people go through, these companies are now really scrambling to catch up, as are all the auto manufacturers who, independent studies are suggesting that this shared electric transportation is going to reduce the number of passenger vehicles in just the U.S. by about 82% over the next 13 years. They estimate that from 247 million vehicles on the road by 2020, we could see as little as 44 million 10 years later. So the pace at which this is happening is upending all of the status quo businesses that have been predicated, on these old models. And this is going to be very healthy for consumers because it's going to bring down costs dramatically. It will increase their available cash flow and allow them to pay back this debt and start building up their savings again. But for, the businesses that everyone assumes are the obvious, have been the obvious money makers in the past 20 years are no longer going to be so, obvious going forward unless they find ways to dramatically rationalize their cost structure, change their product offering, downsize their expenses, and remake themselves.
Governments, too, had better get on board with fast-changing times. For example, in BC, we don't have overall regulations for the installation of solar panels on homes. Every municipality is different, and it can take you years to get permission to put a solar panel on your house. Also, what about the legal liability? You get into your robot car, you're drunk, you have no intention to drive. Can you be charged with impaired riding?
Mm-hmm. Well, the legal system and the regulation and the laws have to catch up really quickly because the pace of this change is coming so fast now. And this all goes back to something we've touched on before, Jim, which is the speed of our computation ability has leapt just so much in the past even decade. The ability for, computers, for example, are being taught, to think for themselves now, and there was even, some that are actually learning to talk to themselves in a language they're creating. I mean, this is mind-boggling. This is sci-fi stuff, right? So it can have dangers and concerns for many people, the risks of AI, becoming dominant and sort of running away from humans and what we want it to do. but also at the same time, it's just the pace of trying to keep up with this innovation. So, of course, consumers, back to what I was talking about before, it makes sense for consumers to be able to harness free energy, collect it, and produce it for the grid. You know, when we saw the solar eclipse this week, the battery installations around the country were able to provide, to bridge over the gap in solar production, which was lost. You know, you think, oh, well, there's not that much solar in the world yet, and yet with the solar eclipse that happened, there was a dramatic drop. So we significantly rely already on solar, and that's only going to increase. And battery technology is, of course, going in leaps and bounds as well. So everyone who thought, oh, but you can't ever get, store power, all wrong. It's being stored. So, and that's just getting better. So I think, we have to really push our governing bodies to catch up here, and that means that consumers will demand it, businesses will demand it, because there's so much opportunity for businesses in this new space. Maybe not the antiquated, slow-moving ones who are still trying to peddle the past, but the startup culture is really, coming on board with access to finance and people who are seeing the future and saying, wow, of course we want to have automated cars. They're a lot less likely to make mistakes than humans, and they are going to be on the road within the next 4 to 5 years. That's not going to change. And so, we'll have to make decisions about what laws make sense as we go here.
Also something, Danielle, I saw an interesting article on your blog about lab-grown beef. What's the story behind that? And does that mean you may end up growing your own steaks?
I know, and many people find that a revolting idea, but this is the reality. We have, we cannot continue to do factory farming for 8, 9, 10 billion people in the world in the way that we, developed agriculture for 2 and 3 and 4 billion people in the world. The inefficiency and the waste of energy, of water, of pollution. Never mind animal rights and or animal rights concerns or suffering of that sort of thing. That's to one side. I'm just talking about resource utilization. So obviously, I'm a vegan. I don't want to eat meat grown in a lab, but many people say they love meat and can't imagine living without it. So I thought it was very interesting that this company, there's several companies actually, Beyond Meat, this one's called Memphis Meats. It's a San Francisco-based, what they call clean meat company, which has had massive injections of capital from, conventional investment types like Bill Gates and Richard Branson, the Welshes, Kimball Musk, who's the brother of Elon Musk. They're seeing that there's a huge demand for this technology, which allows them to literally take meat cells, like animal cells, and grow them in a lab without ever having to create a full, sentient being that you then have to slaughter and, do away with its parts and all that. So there'll be, just pure meat grown. This is like, this is at a cellular level. This is science. So these, we tend as humans to have, I hate that. I could eat this, but I could never eat that. Really, if you get down to the molecular structure, that kind of argument makes no sense. We're all basically carbon-based forms of different food that we come to consume. So it is really transitioning and challenging our traditional way. We know for sure that we have to get people eating a healthier diet for the healthcare system, for their own longevity and productivity, because we are literally going bankrupt trying to care for all the sick care costs, and the public funding system is not going to be able to support people who don't have a better self-sustaining habit with regard to their health. So we know for sure we need better food. We need a tax system that penalizes the bad food and supports healthy food, and that's got to transition. This in line with the rule changes we're talking about. Right now we have a system that poor people have to eat junk because it's affordable. That's completely backwards. We're going to have to change that so that the fresh, locally produced stuff that's good for the environment and good for our health and puts dollars into the local economies, again, that has to be the priority in our tax system. And secondly, we have to open our minds about how we prepare food, how we get it, So we are going through the hydroponic growing system, the vertical farming, and indeed these. If you want meat, fine, we can grow that on a cellular basis, but we don't need to grow most of the grain in the world, feed it to animals who we then slaughter, to get that meat. We can do it in a much more efficient way, and that's what some of these businesses are literally already developed the technology for.
Danielle, thank you so much for being on This Week in Money.
Hey, thank you, Jim.
My guest has been Danielle Park, editor of the popular blog Juggling Dynamite. Her website, jugglingdynamite.com. And that wraps up our show for this week. We'd like to thank our guests, Ross Clark, Hilliard MacBeth, and Danielle Park. And thank you for listening. Let's stand by. We'll have company showcase updates with American Manganese CEO Larry Reaugh and GlancePay.com co-founder Penny Green. I'm Jim Goddard. If you have any questions for the show, you can send them to info@howstreet.com. We'll be back next week with more This Week in Money.
Comments made on This Week in Money are an expression of opinion only and should not be construed in any manner whatsoever as recommendations to buy or sell any financial instrument at any time. Archived online at talkdigitalnetwork.com. This Week in Money is a production of Howe Street Media Incorporated. Executive producer is Tom Allen. Welcome to Company Showcase, an advertising feature on HoweStreet.com.
I'm Jim Goddard. We're speaking with Larry Reaugh, CEO and President of American Manganese. Welcome back to the show, Larry.
Well, Jim, happy to be here. Another sunny Friday.
How's your Portuguese?
Oh, I'm brushing up on it, but I can't even order coffee yet, so that's going to be difficult.
You're off to Portugal. What's going on there?
Well, there's a conference, the Congress Battery Recycling Conference, and we've been invited to present there. So Norm Chow and I are on our way over, and we've already been contacted for meetings over there. So that's always great for the company. It's just another cred for the company. It gives us more credibility that we're invited to these various conferences, and of course we've been to the NatBat conference and the Cobalt Institute conference, and now this Congress one at their invitation. And I'll go further into that, but one thing I wanted to mention to everybody is that there's actually a conference that's going on Monday and Tuesday in Vancouver, and it's called the World Gold and Nickel Cobalt. And Cometco has been asked to present a poster at that, and they've got a booth at it. So I'm going to be attending down there because there's a lot of big names in the industry that will be there. And it'll just give the company another opportunity to further promote its recycling program and make people aware that, we've gone from a company that was an idea less than a year ago to a company that's actually recovered 100% of the cathode metals, and we've actually produced batteries out of all those different chemistries. So this is a huge step, and we're less than 3 months away from applying for the final permit with the U.S. patent, I mean. And so things are moving a lot more rapidly than we'd like to think. When you look at the market today, you'd wonder, gee whiz, what have we accomplished? I mean, the stock goes up or tries to go up, and it gets pushed down, and for no reason that the company can explain. I mean, the fact is that everything's been a big, huge step forward for us and never a step back, and yet the stock's acting like, holy God, we failed somehow, but we haven't. We've actually taken it from an idea to proof of concept to actually producing batteries out of this material.
And Larry, the prospects seem pretty exciting to me because self-driving cars, they're not around the corner. For example, in San Francisco, Google staff already are in electric self-driving cars. So the market for car batteries, it would seem, is just tremendous.
When you look at the market, Jim, it's staggering. And in our presentation, in Portugal and at Lisbon, there will be some discussion about the value of all these batteries that are predicted to be, and it's a staggering number, the cathode material. And we're in the right spot at the right time. And we've gotten attention from all different aspects of the product, from end users to recyclers to commodity traders, looking for off-takes, or other people big companies looking to diversify. So, I think that, once the realization finally hits out there that this company is not a flash in the pan, or it's not somebody that just says they're going to do it and does nothing, we've done it. And that's going to become a realization, and will be the foundation of us moving ahead. So I couldn't be happier about the results that we've gotten to date. I mean, what's wrong with 100% recoveries? I mean, gee whiz. What's wrong with making actual rechargeable batteries out of the materials that we recovered? I mean, we recovered in a position that we can actually sell it back to the battery manufacturers or the people that make up the different chemistries for the batteries in a state that's that's a pure state. So, it's I know we got competition out there, but nobody has been as transparent as we are about the results, and so I can't comment on what they're doing.
Larry, will American Manganese be making its own electric car batteries?
No, the electric car battery business is a crowded space, and there's a lot of pitfalls in it. And, there's thousands of people that manufacture lithium-ion batteries, and there's hundreds of failures every year, too. So, no, we'll stick with selling the product. There's a lot of money in selling the product, and that's what our business plan's all about, Jim.
Don't you have a test plant you're going to be making in Richmond that tears the batteries apart and recovers all the goods inside?
No, we're going to sidestep that for now. We're building a pilot plant to be, and then a commercial plant, and but the plant size will be fairly small because remember, you're dealing with pure material. You're not looking at putting through thousands of tons of waste to get a pound of not thousands of tons, but thousands of pounds of waste material to get a pound of the product at the end of the day. If you put 100 pounds through, you should get 100 pounds out at the other end. So it's a small, very small plant. And we're not looking at disassembly because we do know quite a bit about that there's a lot of scrap that's available, which represents 10% of the lithium-ion batteries. And I put out, that the value of the cobalt alone in, say, 4,000 tons of cobalt per year getting scrapped is about $230 million. That's not counting the lithium, the nickel, the manganese, or the aluminum that's in the battery. So, take a guess, $300 million a year. That's quite a business to start off with.
And Larry, for our new listeners, can you explain exactly what American Manganese does and why you're so excited about what you do?
Well, American Manganese, through its manganese projects and the patenting of a process, became aware through Norman Chow that there was a good chance that we could actually recycle lithium-ion electric batteries, or electric vehicle batteries, and so we pursued that through proof of concept right up to actually having produced 100% of the product at the end of our bench scale tests and made batteries out of it. So that's what we're doing. We're still maintaining our mining projects, and we're in the right areas. We've got a high-grade copper-gold project up in central BC, and we've got a manganese project in Arizona, and I'm getting a lot of attention on the manganese, too.
Larry, where is American Manganese traded and under what symbols?
It's traded on the Toronto Stock Exchange Venture under the symbol AMY. It's traded in the U.S. under the symbol AMYZF. And it's traded in Frankfurt under the symbol 2AM. Our website is AmericanManganeseInc.com. Our phone number is 778-574-4444. And you can contact me at that number, or you can contact me through an email at LREAUGH, spelling of my last name, at AMY, Amy's symbol, MN, symbol for manganese.com.
Larry, thanks for the update.
Okay, thanks, Jim.
I've been speaking with Larry Reaugh, CEO and President of American Manganese. We were speaking on August 25th. I'm Jim Goddard.
Comments made on Company Showcase are an expression of opinion only and should not be construed in any manner whatsoever as recommendations to buy or sell any financial instrument at any time. Archived online at HowStreet.com. Company Showcase is a production of How Street Media Incorporated. Welcome to Company Showcase, an advertising feature on HowStreet.com.
I'm Jim Goddard. I'm chatting with Glance Technologies COO and founder Penny Green. Welcome back to the show, Penny.
Thanks.
What kind of new news can you tell us about Glance Technologies?
Well, we have an exciting announcement that we just released today. Glance Technologies has entered into an agreement with a leading chain with 90 locations, and it's the Ricky's Group of family-style restaurants. So they have 90 locations across Canada, and their restaurants include Ricky's All Day Grill, Ricky's Country Restaurant, and Ricky's Cafe.
How did the deal come about?
Well, it's kind of interesting, actually. There was a franchise owner from Victoria who was in Vancouver dining at a restaurant that had Glance Pay. This was about 4 or 5 months ago, and he loved it. He enjoyed the experience, and when he got back to Victoria, he reached out and said he'd like to get Glance Pay in his restaurant, which was a Ricky's in Victoria. So we remote launched him, and he was up and running for several months, and he said, "This is great. I'd love to get you guys introduced and maybe into the entire chain." So we were pretty excited to get that introduction, and that was a couple months ago, and now we've signed the entire chain, and we have launched in one of the Ricky's Cafes, which is a newer concept. We just completed that launch yesterday.
What was it about Glance that appealed to Ricky's?
The thing that I think, one of the things that Ricky's really liked, I mean, they began as a pancake restaurant in BC in 1960, and over the 70s they evolved into a successful restaurant franchise, known for big breakfasts, large portions, and extensive menu. And then they recently came out with a new concept, which is Ricky's Cafe, which was really designed to appeal to a more modern demographic and offer a more modern dining experience. And Glance Pay is really cutting-edge technology for payments. It's as modern as you can get. It allows customers to pay with their phone, and then it allows the merchant or the restaurant to gather the information from that to help them make decisions about what products to offer. They can do targeted advertising, other user data. They can help drive good customer reviews to good sites, which is really helpful as well. But one of the big things they really liked was our rewards program. So our Glance Pay system has an automated rewards program, which is customized for each restaurant. Ricky's decided to go with a program that for every $500 you spend, you get a $50 credit. That's pretty significant if you think about it, because that means if you're at Ricky's and you use our app to pay, instead of just using your credit card, you're building up 10% of what you spend as a reward. So you're collecting money, and that's in addition to whatever you're collecting through your MasterCard or your Visa. And companies have realized, and successful chain restaurants like Ricky's know, that if you have a rewards program, it's a great way to drive customer loyalty and retention.
How have your investors reacted to joining up to Ricky's?
It was a great announcement today. It's something I think the markets wanted to hear. They wanted to know that our technology is validated, that it's actually being used by leaders in the space. And so when we announced that we signed this 90-restaurant chain that is so well respected, especially since the owner who owns Ricky's is also the owner of Fatburger Canada, I think the investor community was very excited. We can see that we traded over 2 million shares today on the CSE. We're up 9%. We traded over 300,000 shares in the U.S. markets, up 14%. So I would say that's a very positive response.
How successful has Glance been in the last year?
It's been growing very rapidly since our launch 11 months ago. To date, there are over 230 locations signed up to use Glance Pay. And the mobile payments industry is already valued at $5.5 trillion in China, and it's expected to grow very rapidly in North America over the next 3 years as well. And so we're really well positioned to be a leader in mobile payments with already our strong presence in Canada and now our intentions announced for U.S. expansion.
Where do you see the industry of using your phone to pay for things going?
Well, like I just said, it's a growing industry. I don't think people really appreciate how fast it's growing. I think that the whole user experience of using your phone to pay is going to change tremendously over the next year. And I think as people go to restaurants, they start to notice really that mobile payments is the way of the future.
Now, just how does Glance Pay work, and how easy is it for a person to sign up or get involved?
The Glance Pay app is very easy to use. Anybody can download it from their phone wherever you are. We're available in the U.S. and the Canadian app stores. We're a free download. So when the first time you want to download the app, you download it, and then you can kind of play around with it, see what it has to offer. We've got restaurant discovery and other merchant discovery. You can kind of take a look through and see how it all works. And then once you're ready to use it, you can load up your credit card information. We don't store it. It gets tokenized through a bank. And then it's basically an app to allow you to keep track of your expenses and to make lightning-fast payments.
And we've seen, the start of the technology where people could take pictures of their checks. How does this work? Do you take a picture of your bill, for example?
Yes. The original technology that we developed was to take a picture of the bill, which is what happens when you're in a sit-down restaurant with the Glance Pay app. And that's patent-pending technology. We spent many years developing that, and so our system picks up the information in the bill, such as the bill number, the amount, the table, the waitress, and sends it to the restaurant. That's been very successful, and that is our proprietary patent-pending technology. But because we were getting a lot of inquiries from quick serve and cafes and such, we developed another aspect of our technology, which is the quick serve version of Glance Pay. So for the user, it's the same. They don't really know which version the merchant is using, but what we do see is merchants really enjoy the quick serve application because now they can just send money directly. They can send a bill directly to the customer just with the press of a button, and the customer can accept that payment and pay it with a press of a button in the app. Also, any customer can send a payment to any merchant that they want at any time from any location.
How secure is it?
Our system's very secure. We've developed anti-fraud provisions and features which for the past 7 months have been 100% successful in basically preventing fraud.
What would happen if somebody stole my phone? Could they get that information and then stack up bills on me?
No, we haven't had an instance of that happening. Typically, people do have passwords on their phones, and it would be very, very risky to be sitting in a restaurant and using a stolen phone to order something. You'd have to have the phone on, and I assume if it was stolen, somebody would be able to track it.
What platforms is Glance traded on?
We are listed on the Canadian Securities Exchange under the symbol GET. We're also traded in the U.S. on the OTCQB under the symbol GLNNF.
And how can people get more information about the company?
Go to our website, glancepay.com, or download the app and take a look through it. It's called Glance Pay, and it's available in both app stores.
And all your contact information's there?
Yes.
Penny, thank you so much for giving us this update.
Thank you, Jim. It's been a real pleasure.
I've been speaking with Penny Green, the COO and founder of Glance Technologies. We were speaking on August 22nd. I'm Jim Goddard.
Comments made on Company Showcase are an expression of opinion only and should not be construed in any manner whatsoever as recommendations to buy or sell any financial instrument at any time. Archived online at howstreet.com. Company Showcase is a production of House Street Media Incorporated.